Many long-term investors that have been within a space for quite some time and have performed rather well have certain investment principles that have helped them to get where they are. That is what we're going to discuss today, so make sure you stay tuned in. Hi everybody, my name is Nev of One Deal Away, and what I want to do in today's video is I want to share with you some of the investment principles that I have that many of the investors that have been with the space for a very long time have and run and operate with to ensure that they prevent losing money in good or bad times. Now, there's no guarantee that every time you invest you're going to make money. You're going to lose probably as much as you gain, but what you're looking to do is to reduce your losses and increase your gains. And as long as you can run that, you should be pretty okay. But what are some of the principles? You know, when people talk about investing, and even when I do my own courses to talk about investing and that kind of stuff, I always talk about the mindset. Now, the mindset is incredibly important because it's kind of how you think and behave, whether in good times, in bad times, when you're happy, when you're stressed, when you feel pressured. All of those things is what drives our ability for performance or the lack thereof. Look, you can make money in just about any market, just about any asset class, just about anywhere in the world. Equally, you can lose money just about in any market, in any asset, and anywhere in the world. There are people that have been, for example, let's look at something. Real estate. Real estate has been existing for centuries. There are many real estate multi-millionaires, billionaires, potentially, if not even trillionaires, that have been able to make quite a bit of money and quite a nice return within the space over the time. Yes, it's a little bit more challenging when times are rough, and it's a bit easier when times are good, but they have been able to sustain and do really well. On the other hand, we also have a lot of people that have attempted to get into real estate, have done pretty okay when times went well. Some actually didn't do well even when times went well. But then when we had a giant crash of 2008, they lost everything and never recovered, never went back into the game. We have people that have been doing incredibly well within stocks and bonds because they understand stuff, and when the market was doing great, they did amazing. When the market didn't do so good, they did pretty okay. Some that were investing were actually still returning quite a bit of money back to themselves and some of their investors, while some people lose money even in a bull market. Crypto, for example, Bitcoin has been over, I don't even know how many thousands of percents, or is it more? I don't know. But there are people that have been there that have purchased a Bitcoin for as little as like 50 cents or 10 cents or $1. And, you know, you would think at the prices of well over $9,000 today that they would be doing pretty darn well, right? However, there are many of those who have lost money even in this amazing, out-of-this-world bull market that Bitcoin has been experiencing over the past decade or so. So how is that all possible? Like, what causes one person to win, so to speak, to make money in the exact same environment, same market, same everything, and another person to go bust? Like, what is it? If it's not the asset, if it's not the asset class, if it's not the money, because it's all of it is the same, and it has to be the investor. That is why I'm talking about that the mindset is the number one thing that you want to pay attention to before you even go out to do anything. Now, what is some of the things that people are doing that might be causing you to want to like run into stuff and like, you know, follow things? So what happens is that I mostly blame educational system, not necessarily the teachers, not necessarily particular schools, but education as a system as a whole, because they don't teach us about money, they don't teach us about investing, and no, even if you were to go out and get a fancy schmancy MBA, they won't teach you much of these things. It's pretty sad, yet true. Because we don't know necessarily what's going on with the markets and stuff, we're always looking for bits of information. So when we see somebody doing really, really well, we want to pick their brain. So we always get and say, what's the hot tip? What should I do? What are you buying? How am I going to buy? What is the next thing that is going to come up? We get super hyped up, and then we jump into something that we don't understand. So the first principle is knowledge That is not how you spell knowledge. Oh my gosh. Clean it up. Knowledge. There we go. That is how you spell knowledge. Apparently, you should learn how to spell too. Or I should at least. Okay, so knowledge, understanding what you're investing in and understanding the underlying fundamental pieces within it. A fundamental pieces basically means of like what's underneath the whole thing. Like when you see a stock price of $200 per share, is that good or is it bad? A lot of people evaluate it based off of the price alone. They look at their account, they look at the price and say, yep, I can afford one of these. Here's $200. I'm going to buy it. That's that. Cross my fingers, hope things go up and I can make money. That is a bad way to invest in anything whatsoever. It's actually a bad way to purchase things, in my personal opinion. But knowledge and understanding of the market and what you're actually buying is going to be the number one step. Understanding how certain things perform within different markets goes right back into the knowledge. So that if, for example, if I know that inflation is running rampant, investing in debt is a losing proposition because I know that inflation eats debt, meaning it eats my returns. Why would I invest in something like that? That doesn't make sense, right? Also, if I was to invest, for example, it's kind of like if I was to buy a pair of boots, really nice winter boots, and then I buy them in, say, May. Now, that makes sense if you're staying somewhere where there's cold because right after May, June, July, and August, winter is coming and you will need those boots. Kind of makes sense. But if I was buying a boots right now, today, in May, which we are actually in May, and then decided I am moving off to, I don't know, Cyprus, where it's perpetual summer and you basically go from flip-flops to maybe sneakers or maybe nice dress shoes if you're going to work, you don't really need boots because it never gets that cold, like ever. That doesn't make sense to do. So why would you do it? Just because the price was low? Well, that's silly. You're never going to need it. So why worry about it? So that's kind of what I'm talking about. Understanding the direction of where things are going, understanding the fundamentals of that particular company or the particular asset, understanding of when you look at the graph, what does it tell you? Is the trend going up? Is it down? Is it kind of sideways? You can see it. Graphs are amazing ways to evaluate just about anything because most of us are very visual creatures. So you can look at that graph and just look at it for yourself. What is it telling you? Now, I know that there's very specific ways to do technical analysis, to analyze the charts, and you'll see a chart kind of like this, right? And then there's stuff, and then people are drawing like lines, and then they are doing like retracements and all this different stuff. You don't have to get that fancy to understand the big picture of where's this going. If you look at this chart, even without all the lines, you kind of see that it's more volatile because look, it went up a little bit, but then over here something big is happening, and so it gives you some information. It gives you a bit of information, and that is the key component that you need to do. Okay, now that we cleaned that up, let's continue. So knowledge into a particular piece is incredibly important, and that's pretty simple. Don't just go out to get a particular what stock should I buy, what crypto should I buy, what property should I buy, where exactly is that property located, which is all of the important things. but understand the fundamentals behind it. And instead of seeking gurus to tell you exactly what you should buy next, you should be seeking individuals that are willing to teach you of how certain things work so that you can understand it for yourself, so that you don't have to rely on anybody to tell you stuff. Okay? Second component is long term. Okay? Long term. What you want to do is you want to decide of what kind of a person are you, right? If you're investing, you should be investing for long term. You shouldn't be focused on, am I going to get $10 back tomorrow, or is this going to go to the moon in a month, or what is going to happen? But you want to look at the long term, sort of what is coming and what is the prediction, and then across the time be able to actually buy it. Now, I have mixed feelings about dollar cost averaging. I think it's a solid foundation to put in a bit of money every single time, but I also have hard time that when I see certain things, which goes back to the knowledge component, when I see certain things that are telling me that everything is going down, I have hard time buying it. I like to kind of wait for that steep downtrend to actually slow down, potentially even stop, and then continue to buy so that I can keep on buying it on the way up. It's really hard to predict the markets and try to time them. So of course we all want to do one thing, right? You have a market, we all know that most markets are cyclical. You want to sell here and you want to buy here. We all know that, right? Because if you sell here, then you don't have this loss, then you buy it, you go back up, you sell over here, and you avoid this loss, and so on. And then you're able to stack the gain to the gain so that your return doesn't look something like this, but your return looks like you bought here, right? Then you sold, you waited, and then you bought another down here, right? Or maybe even lower, so that your chart goes like this and like this. And so your actual yield return is stacking on each other, which is what making it really, really cool when you look at it over the long term. But this is really hard to do because none of us can predict exactly when the top is or when the bottom is. Now, there are certain things that you can watch through your knowledge and understanding to be paying attention to kind of see, well, you know, things are getting a little bubblicious, so maybe I should step out, put some cash aside, and hang out and wait. Investing is pretty darn boring, or at least it should be. Now, trading is exciting, it's fast-paced, and that's different. Trading basically means I go in, I trade it for something else, I trade it for something else, I jump from this thing, I jump to that thing, doing all of those things, and that is exciting and fast-paced. Investing is pretty darn boring. You spend most of your time analyzing, watching, waiting, and then every so often you jump in and you're done. And then you go back to analyzing, watching, waiting. It's very, very, very boring, but it's very profitable. Part of the problem is that people feel like they need to keep doing something all the time, all the time, all the time. So what they do is they jump from asset to asset, from class to class. They keep moving, shaking, all these different things, thinking that they are doing stuff. They're not. Most of them are not. Now, that's part of the piece. So you want to be a long-term, especially if you're an investor, right? 3, unless you know what you're doing, okay, don't trade. Okay? Don't trade. The reason I say don't trade is that you want to spend most of your time learning, focusing on long term, and if you understand what you have purchased and the underlying fundamental components are really, really good, and you looked at the charts and it makes perfect sense, then you're going to hold on to it for like ever, basically. That's kind of what the plan is. And so if I know that I purchased something that is really, really good, why the heck would I jump out of it, jump back into it, jump out of it, jump back into it? Because every time I trade, there are fees. Those fees are reducing the amount of money that I have within the particular system. So let's take a look at something that people are very, very familiar with, stocks, right? That's what everybody's familiar with. Let's say that you have $10,000 in a particular account, right? Okay. Well, in order to buy stocks, most of the exchanges are not actually free. So you have to pay 10 bucks to buy and to sell. So basically, for a transaction, it's 10 bucks, but the overall cost to get in and out of something is 20 bucks. Now that doesn't sound like a whole lot of money, right? You're like, it's just like 10 bucks off of the 10,000. Like that's not a big deal. Well, not so much. But if I have like say 1, 2, 3, 4, 5, 6 different stocks that perhaps I'm enjoying. And so I buy this one, right? So that's 10 bucks, 20, 30, 40, 50, 60, 70, 80, 90, 100 bucks, right? And all I did was just trade. Well, this is 100 bucks. Now, the hope is, and the argument of the traders is that, well, if I bought here and I made like 20 bucks and then, right, that's okay. But problem is that if I bought something that I buy for long term, meaning it's not something that I just want to buy and like flip right out, but I'm buying because I need to get long-term investment component, doing this stuff is causing me to actually lose money because I lost 100 bucks just doing this stuff over here with you. And again, it's 100 bucks, doesn't seem like a whole lot. But if you do this, say in a week, you lost 100 bucks in that particular week, you no longer have $10,000, right? You have $9,900, right? Okay, so you no longer have this. This is what you have now. Now, you repeat the pattern a few more times over the course of a few more months and a few more years. Next thing you know is you are down to $5,000. Most of the time, folks don't actually notice this stuff because we tend to do this in a environment where we actually keep consistently putting money in. And so what we sometimes see as sort of the return is not necessarily the return, or what we see inside our account, it's not necessarily like the return. It's more like money that we've actually put in. So one of the things that you don't want to do is you don't want to keep on trading all the time and chasing this sort of shiny object, because chasing the shiny object makes you lose. And so what ends up happening is, right, like we see this particular thing right here and it's like performing okay, but it's doing this. And then we see this thing over here, which is investment Y, and it was doing like this. And then it did this. We're like, oh my gosh, look what it's doing. Look what it's doing. It's up 50%. We eliminate this. We jump into this and we buy right around here. Well, when it does this, guess where it goes next? Right down here. So then we go, oh man, I need to get out. So you get out of this stuff. You see this thing over here. This is where you got out. And now you get over here, so you lose on this component over here of the returns that you could have gotten, and so on. That's what we end up doing. That's the reason why I keep saying, don't trade. Yes, you can and you should put money into different particular assets. What you don't want to do is keep jumping from one to another, one to another, one to another, because that is how vast majority of people actually lose their money. That brings me in to diversify. Now, when I talk about diversify, I want to make sure that I'm being very specific of what that means. And that basically means is that I want to spread out my returns or my investments in a few different categories. I don't want to bet on just one horse, because my chances of winning, chances of getting that money back, actually go down. Now, it could be an amazing horse, but you don't want to bet all of your money on that particular horse. Maybe you want to bet on like 3 or 4 top horses within that particular race. Now you have a greater probability that you can actually get some nice returns. One of them is not going to return a whole lot. One of them is going to be like really good. One of them is going to be like one of them could go down. But overall, you look at your portfolio, meaning all your different holdings and how it's performing as a whole. That is one of the ways that makes sense to kind of set things up. Now, you don't want to over diversify. Over diversification is also not a good thing, because if I have, $10,000 and I have 10,000 different stocks, well, I only have like about $1 per one. And so while, five of them might lose 20%, you were like, that's okay. I just went from $1 to like 80 cents. I don't really care. You could also have some performance or some stocks and holdings in that portfolio that have gone up like 40%, but you've only made 40 cents, if that makes sense. So you don't want to over diversify based off of the amount of money that you have to invest. You want to put in a nice sort of chunks in kind of, you've likely seen people will do something like this. Hold on, let me erase this so we have space to play. What you want to do is, you've seen people kind of have this, and there's this like pie, and they say, okay, well, this percentage over here is for this, and this percentage is for that, and then this is over here, and then this particular thing, let me make it a little bit different so it's easier for you to see, is something else, and then I still have, some money in here, right, and then some money in here, okay? This is kind of what portfolio diversification looks like, where you go in and you take out and you kind of chunk it out. If it looks something like this, where, you have so many of the things that it's like ridiculous, you're like, I can't, right? This is just too much. You won't be able to pay attention to all of those things. And remember, knowledge is kind of how we started with, and paying attention is the really big, huge component of this whole thing, right? So that's part of it. The other part of it is that you could have some really good performers, but it's not doing stuff. So that's kind of the piece that you want to pay attention to, is you want to divide it in something. So people are saying like, well, like what is the good number? Well, it kind of depends on who you are, what your needs are, what you're looking to do. And when I'm thinking about diversification, I'm not necessarily just thinking of like just diversified portfolio of stocks. That's not what I'm talking about. I really am talking about different asset classes. So maybe asset class, part of it would be, maybe I will have some money in stocks, right? Maybe 10% of my money is in stock market, in equities. Maybe 5% of my money is in bonds, for example. Maybe 10% or 20%, or however, is in gold, right? And not necessarily paper gold, but like physical gold. And maybe, 30% is in real estate. And maybe, right? You understand what I'm talking about. And when I say real estate, I'm talking like physical homes, houses, industrial complexes, land, that kind of stuff, right? Like not just REIT or any of those things. Like that's not what I'm talking about, because you're still in the paper asset. So you need to start differentiating and thinking through like, oh, okay, when we talk about different asset classes, it goes right back to the knowledge, which is why I started with the knowledge. Everything starts with the knowledge, with the understanding component. And so when I talk about diversify, is you want to run a relatively simple portfolio. So this could sometimes be that, say, for example, I will have a portfolio, right? Like we could see, like a super simple, right? Which each one is 25%, right? 25% all around. And, I'm going to say that, okay, this is what my portfolio is going to look like. And maybe, part of this is going to be real estate. Maybe part of this is going to be stocks. Maybe part of this is going to be crypto, right? Maybe part of this is going to be cash. So whatever you want to do, you can structure it in many different ways. And I'm not saying this is what you should do. I'm actually not saying do this at all. What I'm saying is, it could be very simple. And if you compare this, right? So compare this one to this and this, right? You will see that there's difference. Like, look how complicated and complex this is. Like, who's going to track that? Nobody, right? We don't want to do this, okay? This one is okay, right? It doesn't have a whole lot, but it could get a bit more complex. And then you have something right over here, which, is pretty easy and simple. So that's kind of what I'm talking about that you might want to do. Now, the second piece is that just because we talk about diversify, again, most people just focus on stocks. I'm saying go through different asset classes, and then even within that asset class. So say, for example, here's my 25%, real estate piece that I had, right? So even within here, and I drew a house because that's an easier way to represent it, but even within here, maybe, 10% is going to be in single family homes, and maybe 90% is going to be in multifamily, right? That is also a diversification within the market space. And then even within this 90% over here, I don't know, 30% could be in Northwest, 50% could be in South, and what do we have left? 20% could be, I don't know, West Coast or New England, right? You can kind of understand what I'm talking about. That too is diversification when we're talking about real estate specifically. So you want to start thinking through different ways of what diversify means and what it can mean for you. And the reason we say that is you kind of spread your money a little bit, not wide, a little bit, so that if one is underperforming, it's okay, the other one should kind of lift it up. The final piece, and this is not everything, but I think if you have these pieces right here, that's going to be huge to help you be super successful within investing. Final piece is going to be is cut losses. Okay? You want to cut losses fast. So what you want to do is when you start seeing something and maybe you made a bad call or market have shifted, you were expecting there's going to be a high inflation, for example, so you position yourself in the asset classes that are going to do really, really well in the high inflation environment, but that's not coming. Those things are not performing at all. Cut them and get into something that might make sense. Now, that doesn't necessarily go with the trade. You don't want to do that on a daily basis, right? This is going to be over, in the trading world, long period of time, but in the long-term investment period, a relatively speaking, short period of time that I might, so if we go back to my real estate example, I might have bought this particular property right over here, right? Or maybe there's a couple of properties within this, and I noticed that there's one that it's like, always vacant, it's really hard to fill, the tenants that I get are not like really good, I can't raise the prices because the market is not, or the rental stuff because the market is not performing. It's just a really big pain in the butt. Sell it. Sell it, get out of it. Find something different that you can invest in. Maybe it's in the same market as a whole, but maybe it's a different area of town that performs a bit better, right? Maybe you expected that when you purchased it, when okay, well the good part of the town is moving this way, so I'm going to buy across the street because once it crosses the street, I'm good. It's one of the strategies within real estate world. But what if it doesn't cross the street, or it's taking way too long, or something happened and they stop at that street, but you didn't know it, and now they're starting to switch the sides, or they go south, or they go north, and you're like, oh man, I missed that one. It happens, y'all. It happens. So it's okay. Sell it. Get rid of it. Get your cash and then get into something else that does make sense. But of course, you don't want to overdo those things. You want to get rid of your losses fast so that you're not bleeding, and then put money into the things that are performing. But be careful, because sometimes you will see things and say that you have 5 things in your portfolio and one thing is not doing really well, right? three things are doing pretty okay, but then you have like one thing that is like super amazing. And we're like, well, Nev said like go into the stuff that does it, so I'm just gonna get everything back into it. No, 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 no. You sell this one, get rid of it. You put a little bit of here, a little bit of here, a little bit of here, maybe a little bit more here, and that's kind of how you reposition. And you find something else to replace number 5, and you get a different number 5. That's kind of what I'm talking about when I'm talking about here. And when I talk about cutting losses, I'm actually gonna give you a bonus one, and that is stop following the gurus when they tell you to go and buy stuff. So I'm going to put it here. So there you go. Stop with the gurus. You don't need gurus. You need people that are going to teach you how to invest. You need books. You need education on how to understand these things so that you can run your own thing. The problem with gurus is that they show up out of nowhere. They're very smooth talking. They make you feel good. They flash their, you've seen people that were like flashing the money. They fan themselves with it. They take fancy photos with like a Lambo or something like that, all in the hopes to impress you. Meanwhile, they're broker than you, maybe. I don't know, right? Because everybody can spend a little bit of money to buy some fake cash, or actually you pull a little bit of money, borrow whatever you need to do. You put it back in the bank, and you're like, all right, that's it. I've done my marketing. Let's move on. Don't fall for those things, okay? Now, I'm not saying that every guru is a fake one, but what I'm saying is that you don't necessarily always understand of what they're doing. I can tell you that I am buying XYZ, but you don't necessarily know at what price I buy it, what am I looking at, when do I get out, do you get the information the same time that I do, can you do the same stuff that I can legally or even financially? No, it's not the same thing, so it's really, really silly to follow somebody. Right? Some of them, unfortunately, do this whole thing called pump and dump. It's illegal, highly unethical as well, and immoral, if you really think about it. But people do it all the time. So they'll say, oh, okay, so here you go. You should listen to me. Here are the 5 stocks that you must own. Or here are the 5 cryptocurrencies that you have to have right now because these things are going to go through the roof. And you're like, yes, yes, that's what I need. That's what I need. So they go and say, all right, you are going to buy XYZ. Okay, then you're going to buy ABC. Okay, and then they give you these things, and you're like, yes, yes. And they're like, and you're going to buy it right now. You do not get out. You stay there. You do the thing. But what happened is that front running basically means that I already own these things. I already bought them. Nobody knew about them. I mean, they're not like they're whatever, right? So I buy them. If I have a large enough network, and these are relatively speaking small things, because you can't do this with something like Amazon, for example, unless you're like billions and billions and billions of dollars in it, and then you have billions of people kind of do it. But you can do it pretty easily with like penny stocks and stuff, because liquidity, there's less money within the market, so it's easier to manipulate the price up and down, right? It's much, much simpler to do it. So then if I go in, there's not much of a liquidity and stuff, and I say, here are the things, and that's typically what you hear, like, here are the 5 like super cheap things that you can get into right now, and then they give you the stuff, they already own it, and then they have, I don't know, 1,000 people all jump in it, right? But I'm already in it. They jump in it. The price does what? It goes up, okay, right? So this is me right here, me, the fake guru. Then, everybody jumps in. I get out right over here. I make a nice sort of percentage and chunk of change return. You sit over here. Well, guess what? Nobody else is buying and stuff. I sold a bunch of things. This puppy goes straight down. That's front running. Or it doesn't do anything. Like if it doesn't even go straight down, it doesn't do anything. And we're like, I thought this was going to happen. And then they show up and say, well, you can't predict the market. I don't know what happened. Here we go. But here we go. We have Bob. Bob actually made some money. Hey, Bob, you want to tell everybody about it? But Bob is actually with the particular guru. So Bob says, well, yes, this particular guru is amazing. He's helped me a whole lot. And, if it wasn't for the guru, I actually made a lot of money. But they are connected. They are partners. You don't know that. It's it's like a magic show, right? When you have a certain magic show, part of some of the illusions in magic shows is that you have, there's a technical name for it, I can't remember, so if you can, drop it down in the box. But you know, you have these people that are like with you on your side, right? Like part of your company, that pretend to be the audience, they pretend to be the customers, they pretend to be there so that they can make the trick work. People are using this, unfortunately, in financial markets. So I'm saying stop with the gurus. Start educating yourself. Spend a little bit of time learning, or you will be spending money for forever and never making it. That is what I want to avoid for you, because I never used to do these things. Nobody ever taught me. You know, all those years with fancy education and MBAs and everything else, I didn't know that you were supposed to do all that, and I didn't even know how to diversify properly, and like all those like things that eventually you end up picking up. So pick up a book, pick up a course from somebody who's doing what you want to accomplish, and not just somebody who's going to get you into like buy the ABC stock, which I don't even know if it exists. So if it does exist, don't buy it. This is not what I'm saying. So please don't do that stuff. I'm using it to explain how sometimes people will do stuff. And, so spend time basically learning and understanding stuff, because, you know, your time is best spent if you learn just a little bit. You don't have to be an expert in everything. You don't have to understand all the nuances of everything, but just have a basic understanding of some stuff, because A, you'll smell the fake gurus way quicker and avoid doing something like this, okay? And you're going to be much better of kind of, where does the market go and how does all of this work? So study, learn, and then implement slowly but surely, and then take small steps every single day. And you know, you could, as a long-term investor, you could do just DCA, dollar cost average. You know, every month I'm going to put $50 towards this particular thing, and $10 towards this thing, and $5 towards this thing. Cool. Okay, do it. And then if you notice that one of those things is not doing it, then you're like, all right, maybe I need to shift something and try something different. And that's okay. That is perfectly fine. I hope that you have learned something and that you have found this, if not educational, maybe somewhat entertaining. I do appreciate you for watching. Make sure you give me a thumbs up if you really liked it. Leave comments below, questions that you may have, and subscribe to the channel and share this video with folks that you think they can help. And until next time, stay forever money blessed, and do remember, you are only one deal away. I want you to be happy. Don't you want to be happy? I want to be happy.